Okay, folks, we're on the final homeward stretch before happy hour. So we're going to go into the last panel session for the day. I'm Howard Rennell from the Wyndham Group, a board member of the NIBA, and I'd like to introduce Austin here from Thomson Reuters, which is going to chair the panel, which is going to have Evan, Rich, and Stefan guide us through the final few minutes.
Great, thank you. So it's a pleasure to be here, and thank you to NIBA for the opportunity to host this panel, which is labeled Quant Essentials. Certainly, last but not least in the order today. Just to introduce our panelists, who I'm very pleased to have with us today. Let's see. On my immediate left, we have Stefan DiTullio, Director of Futures and Options and OTC Clearing at Bank of America Merrill Lynch. To his left, we have Evan Wright, Data Strategist at Blue Mountain Capital. And then finally on the left, we have Rich Brown, Managing Director, Market Data at Schoenfeld Strategic TechWorks. So just to kick things off, and I want to keep it pretty casual, but from my perspective, working at TR, I'm the global head of Quant and Feeds at Thomson Reuters. We look at the quantitative investing space as extremely important to our what we call our non-real-time feeds business. Quant and Feeds is a group within the investment and advisory portion of the financial and risk group within Thomson Reuters, and we're seeing accelerating growth in that space. It's a very important customer segment to us. If you look at the number of assets, the amount of assets under management, I think quantitatively oriented hedge fund managed assets just topped about $1 trillion recently. Its assets under management is growing about 8, 9, 10% per year. So we look at it as a very attractive space. It's a very it's a space we definitely want to be involved in as well. In the hedge fund formation space, it's about the stat that I was very surprised to see, but very welcoming. It's about 70% of new hedge funds are quantitatively oriented. These newly formed hedge funds are quantitatively oriented. So this is a very important space for Thomson Reuters to be involved in, and again thank you to our panelists today. So how about I just kick things off with a fairly kind of high level question to each of our panelists. The explosion in new data sources has driven a structural and analytics evolution. It's accelerated it, but it's also necessitated a change in the way teams are set up to interrogate and exploit this new data. So I was wondering if each of you could talk a bit about some of the challenges and opportunities that this change presents.
Let me start. At BAML, I'm more on an agency side. I'm not generating any alpha, I can promise you that. So the key issue we're having right now, on the future side, we're looking at around 60 exchanges across the globe. So it's a fairly heavy footprint. So what we're looking for solutions which are scalable and reliable from an information point of view. So the old days, most of our effort were based on live market data, basically. In the more recent past, we've been spending a fair amount of time and energy developing new generation of algos. Those are typically, benchmark type of algos, arrival price, VWAP, TWAP. And one thing that becomes pretty obvious is how to forecast sudden change in market behavior, because your typical 21-day VWAP does fantastic on a regular day, but see suddenly there's a change in the market behavior. How do you forecast that market behavior, forecast that change in market behavior? And right now we're spending huge amount of regression, research, trying to find out what type of signal we can use internally within the bank. We do have access to a lot of data which is not necessarily available to the street, and maybe we can benefit from it. And as well as creating consuming new type of feed. So it's critical to work for a firm like Reuters because you make it a lot more scalable and the implementation is a lot shorter. On top of that, we don't always know what's going to work and what's not going to work. So relying on a firm like Reuters to help us picking and choosing which one might work without having a huge investment.
I think one of the biggest challenges we have is really that the more that you're getting data from somebody like Reuters, the more everybody else can easily get data from somebody like Reuters. And so we spend a lot of time, and I spend a lot of my time personally, trying to find new places that maybe haven't even thought of providing data to the marketplace and convincing them that we can be a good partner to them and that we're not scary and we're not going to take their information and put them out of business and do horrific things with it. And that's really I think a key component of anyone in my role at a fund, I think now is really doing that kind of work. And the other challenge, which Stefan alluded to, is finding data that spans a broad enough range to really cover a quant strategy. If you have fantastic data that covers 3-4 names, it can be very challenging to deploy that in a quant capacity and really have that be useful. Obviously, on a fundamental level, it can be quite useful, and you can do a lot of things with it. You may need quant resources to leverage that data. But when you're talking about really deploying things at a pure quant level, you need 40, 50, 60 names at a minimum to really make that work, and that can be quite challenging to find that. And then again, I think the other challenge we run into a lot is finding data that has enough history to really be able to be fully evaluated and tested in a useful way. There's a lot of great things out there around geolocation data where people walk around with their phones, and by and large a lot of that information is only a year or two old. And so being able to take that and really build testing on top of it and have it be reliable in a convincing sort of way is quite challenging, and often compromises have to be made. So.
Yeah, and at Schoenfeld we're a multi-manager shop, so we do both fundamental equity as well as quant. So the challenge that my team has is how do you suck in all of this data and make sure that you've got every different customer or every different portfolio management team's needs taken into account. So it's one thing to streamline it in a certain particular type of infrastructure. It's another one to make those queries optimized for any number of different use cases. So whether it's the sourcing aspect and making sure that you can solve fundamental and quant needs, or the ingestion and the storage of the market data, I think there's a host of challenges across those areas. And without the shameless plug to Thomson Reuters, I think the more normalized that some of that stuff comes in, the more we can deploy our resources on other feeds that might be new and sexy and alternative. So the generic or traditional kinds of data from a provider like Thomson Reuters or some of its competitors kind of help us to streamline some of the other things that we would do moving forward with some of the new emerging data sets.
Great, thanks. And it's always great to hear the success, customers experiencing success with our products. So thank you. And we'll get more into the whole kind of quant overlay and combination with more fundamentally oriented teams in a bit. But perhaps going down the path of how you really engage and interrogate new data sets, because data sets out there, as we all know, we call it the alternative data space or complementary data space. The space is really exploding, right? And it's clear that from customer conversations we've had is that our customers are needing to adjust in major ways here. So I was wondering, it's difficult oftentimes to combine. These data sets are new, they're newer, and they have shorter histories. I was wondering if you could talk a little bit about how you deal with some of those shorter histories or lack of breadth in your process, or how you address some of those challenges.
Yeah, I think Evan touched on it earlier. Depending on the coverage that you would have with any particular data set, 3-4 names doesn't work in any of our quant strategies. We're looking for hundreds of names at a minimum. That being said, we still have to, from my team's perspective, we still have to inventory that, see which fundamental managers might make use of it. So the interrogation, I think, in a lot of cases works the same for both groups. There's a certain amount of history and confidence that you would have on it. What are the substitute products when you're looking at some of it? And a lot of it comes down to opportunity costs. Some of these vendors will come in, they want their 7-figure kind of numbers from a subscription perspective, and you can buy 20 other data sets for that kind of price. So which of the ones which data sets are you going to put in front of the managers and, let them know where there's a little bit more credibility behind the team that's putting the data set together, or the efficacy or other problems that you might have with some of the new alternative data.
I think one of the other interesting pieces about a lot of the alternative data that's coming to the market is because it's coming from processes that weren't designed to generate data for financial purposes, it has quirks and nuances to it you don't see from a lot of the traditional market data that's present. So there's bias in a lot of the data. If it's coming off of somebody's cell phone, which apps are they running? It's not something that everybody has. You need to understand that. You need to understand if that demographic overlaps with what you're doing. If you have a group of people that are using Tinder and you want to understand if they're shopping at, hip replacement places, you're likely to get very different results than if you were looking for something that might skew a little younger. The other thing you find quite a lot, and that we find quite a lot in looking at all this information, is as we work our way through it, we need to really get down into understanding how it's collected and the actual inherent bits of the process that you don't really need to understand about market data. When you get information from a stock exchange, you can just look at it and say, okay, this is truth, this is what's going on in the world. You have to say, how did this get collected? What was the process? What are the things that may be being missed here? There are nuances to it you may otherwise not find to be apparent. And there's data that becomes useful that you need to collect from a reference perspective that you never needed before. And when you think about this, historically companies reported their earnings on a quarterly basis, and you didn't have to say, well, what day did the quarter end? Because they just reported things quarterly. Now, if you're collecting credit card data from the marketplace and you're getting actual card swipes on a daily basis, the question becomes, well, does the quarter end on Thursday of Thanksgiving or the Friday after? That obviously makes a huge difference in figuring out how you want to categorize that revenue, how you want to calculate it, how you want to target it, and ultimately develop your models based on that. And you need to know those things, and those things are not always knowable, and it invites a whole new set of questions that you also need to understand. If you have a question of people walking around and doing things, you have to get questions answered about, well, where are they standing? Okay, this thing is a Starbucks today. Was this a Starbucks last week? When did it open? Did they have a fire? What's going on? And you need to understand those kinds of things, which are entirely new questions to try to answer, and they raise a whole host of other questions after that.
Well, on the sales side, we're not quite there, to be candid. We spend a lot of time and effort to see how we can optimize, use whatever data we have internally. Like I work for a bank, we do have credit card information, all those stuff, but it's fairly complex and it's still the early days because we have tons of issues with respect. We have very strong Chinese wall within the institution. We have huge issue with compliance, legal. I cannot go.
If you want to give it to us, we're happy to help.
Yeah, I'm sure you will be, and I'll be glad to sell it to you. But going to see my traditional bankers and ask me to give me some update about loan applications, so on and so forth, that's not an easy task within my institution. So we're looking at ways to capitalize it, but within the restriction of the bank. The research team use some of this information, as we all know, but I'm not to the point where I can give an API to one of my Quant clients and say, yeah, I will release the data as soon as available within the bank. So I cannot move as quickly as the buy side, that's for sure.
Yeah, and if a firm is going about the decision of the kind of cost-benefit analysis of engaging newly available alternative data, it sounds like it's fairly clear as to what the cost side of the equation might be. But how do you go about determining the benefit, right? How do you go about determining kind of the top-line benefit that might provide to your firm? And I appreciate, there's basically a difference in the sell side analysis versus the buy side here, but just curious.
I don't think there's a big difference. Revenue. For me, if I can identify a source of data which differentiates me from the competition, I can increase my market share, and I do sell a fairly commoditized product, so I got to come up with new tricks. Maybe I have a slightly better arrival price, slightly better TWAP, but that's not going to take me very far. So I'm always looking for new solutions. But how do I gauge my success? It's fairly simple, P&L.
I think from a quant firm perspective, it's actually pretty easy to judge the benefit of anything. One of the challenges I think on the fundamental side is you talk to a fundamental analyst and they have a process and they feel a certain way about something and their conviction is tough to measure. And you say, well, if you have more data, are you more convicted about this? And the answer may be, sure, but how do you measure that? The beautiful thing about a quant model is it's right there in the code in the computer. So ultimately, when our teams do their back testing, they can look through a set of data and say, look, if we had this information as it was at that moment in time and we ran it through the models we have, it'll give them an actual set of results they would have generated, and they'll test a variety of outputs of that. And the bottom line is, if it generates more revenue at the end of the day, if it generates more alpha, they can make more money. They can take that and weigh it and say, okay, if this thing costs $10 and we can make $11, maybe that's worth it. If this thing costs $1 and we can make $1,000, that's an easier conversation. If it costs $100,000 and we can make $1 billion, we can go move and buy that private island we've always wanted. Whatever it is, it's very easy to measure those things. So I think in the quant world, that's actually a much easier question to answer in many cases than it is on the fundamental side.
Yeah, I would tend to agree with that. And on the fundamental side, because we have many different portfolio teams, the cost of that data set may not be borne by a single team. And even if you put them all together, they still may not be able to pay for the data set or the data scientists and stuff to be able to exploit the data set. So there's a certain amount of the house having to cover a lot of those costs, just if nothing else to make sure that the managers who have conviction don't see a data set that could kind of railroad them and be caught off guard. So part of it is a risk management aspect to it, and testing that conviction and really making them on their toes. But again, on the fundamental side, what do you pay to have a little bit more confidence that you were right to begin with? Data can speak for itself, but and you can make it say anything you want, and those are some of the challenges moving forward, particularly on the fundamental side.
Yeah, torture data set enough, it'll confess to anything, right? So that kind of thing. But one thing I was curious about was, are there particular sectors or market segments in which this explosion in alternative data is kind of most tractable? Where you find the most, where you expect to find the most success? Are there areas in the market where it's just not kind of mature enough, or I was wondering if you guys could comment on that.
Yeah, I think consumer's a natural one. You've got the credit card swipes, you've got geolocation, you've got product reviews. There's a lot of things that you could do on the consumer side. So that probably holds the most promise, and that data is valuable even if you have to aggregate up to the firm or the region level. You can start to look at who's shopping in which location and what other locations are they going to, or what other cohorts are they participating in. So there's a lot of derivative investment plays that you can make off of this alternative data. I think travel is certainly another one as well. A lot of web scraping technologies, price comparisons for products that'll get you into the consumer goods space as well.
I'd certainly echo what Rich said. I think beyond that, it's really a question of just where data is available. So if you think about the kind of processes that generate a lot of information, and in some cases, it hasn't all been even attacked yet, things like healthcare, things like the oil pipeline, things like that have a ton of information that's accessible. Those are probably lower hanging fruit. Consumer is clearly by far the easiest one, and the one that probably, 85% of the data out there right now addresses. Some of the more B2B, industrials, chemicals, things like that, those are probably much further down the road as people try to understand information from that process, and some of that information starts exposing itself. I don't think it's clear really how people are going to attack some of those sectors, but in some cases that's why they're the most interesting and have the most promise.
On the future side, I'm more focused on certain type of asset class. So your equity indexes, your commodities, your ags. So depending on the asset class, some data will be more relevant than some others. As I said earlier, we're still in the early days on the sales side. We do not trade for ourselves. So we are exploring, but overall, if you think about it, it's very wide because, I'm interested in what's going to impact crude oil. I'm interested in what's going to impact the boon. I'm interested. I cover 66 countries, so any type of data we can need a slight hedge would give me an excuse to give a phone call to a client to discuss an idea. That's how I'm going to gain business. So how do I take that data, process it, redistribute it? It's still early days. I do not know the answer.
One other factor to look at too is where the data is coming from a geographic perspective. There's a lot more data sets in the United States than there would be in other regions. And some of the managers that we have working with us, they're making trade-offs. Do I take my existing algorithms that work very well in the US and take them into Europe and take them into Asia? Or do I buy this, funky new sexy alternative data set and try to squeeze a little bit more out in the US? So I think there's that aspect too, not just the sector location as well.
And to sort of piggyback on that, and you teed it up beautifully, the other question that comes along with that is, of course, one of regulation and requirements. And, in Europe, GDPR is coming along, and that's, if any of you aren't familiar with that, it has to do with privacy regulations around individuals. That's clearly going to have an effect on a lot of the data coming out of there, and those are key questions that come up a lot around all of this sort of information as you move to new regions and start considering them. A lot of these questions are just unanswered. I don't think anybody really knows, what is the legal status of web scraping in Liechtenstein. I don't think that they've really put that down on paper yet, so these are questions that people need to think about.
Great, and perhaps to move a little bit more, off of, say, just pure content, more into, say, process and implementation. Do you find that, taking these various data sets, that you need oftentimes to triangulate to find a relevant signal once you interrogate that data set? Is that kind of something you generally need to build into the process, or is, let's say, like every data set you can get kind of good enough standalone? Just wondering.
You're giving way too much credit.
I mean, from our perspective, we're probably have, 100 or so data vendors that we're actively talking to about things right now. The ones that require less triangulation and are more obvious and it's easier to find good results out of are the ones we're working with sooner. Some of them are quite complex, and conceivably there's amazing value to be had, and hopefully one day we'll find that. But it's hard enough to work with one data set or two data sets to triangulate multiple ones and bring them all together and say something magnificent. Yeah, it would be great if we could all say, here's the web scraping behavior, and here's where they're walking, and here's what they're buying, and here's what they're browsing on Amazon, and here's what their children are doing, and here's where they're traveling. We're a pretty good way off from that, I would think.
Yeah, and if you sort of look at the Cambridge Analytica models, where you're trying to get propensity of what people are going to do, they've got that all from a single profile. You're not linking, Evan's ID on Twitter with Facebook, with his geolocation information, with his credit card swipes. So it makes it much harder to look at those kinds of things across data sets. But I do think, when you start to get into the reference information that you were mentioning earlier, CUSIP, Bison, CEDAW, RIC, Figgy, Perm ID, kind of mapping going back decades, products to companies to tickers, corporate chains, mergers and acquisitions. When you start to look at all of those kind of complexities and when they existed at a certain point in time, you can do a lot with some very interesting data sets and start to cross-reference those. When you look at single sources of data sets, when I was at Thomson Reuters, one of the things we pitched was new sentiment and whether or not you can buy or sell off of that 12 years ago, right, as a single factor. And what we've seen, over the last decade or so was a lot of other people coming out and saying, okay, where else does this, what does it combine with, and what kind of behaviors do you see? Did the news article emerge after an idea popped up in a blog? Does it hit, social, then Reuters, then CNBC? And sort of, the holy grail is, where are you at in that information cycle? So in that specific case, you do have to triangulate across a number of different sources if you're going to find the best value in any one of those single data sets.
Great. Yeah, I wanted to get back to the whole notion of, kind of combining, systematic quantitative process with, more fundamentally oriented teams. We're seeing a lot of that. I'm seeing a lot of feedback from customers, looking at that. What are some of the challenges with doing that, right? You're dealing with, different folks who kind of speak two different languages, if you will, but, I'm sure I'm simplifying the idea here quite a bit. So I was just curious if you could talk a little bit about, when a quant team provides an overlay, if you will, to a fundamental strategy, what kinds of challenges can pop up?
Personalities, probably more than anything, and whether or not people can actually, step out of their own comfort zone and start to look at where the data may benefit them and where it may not. A lot of times we have different teams. You've got to kind of steer them to where you think some of the value is for their particular strategy. Don't give them the open access to the catalog because they'll be chasing the next shiny object. And don't try to change fundamentally what they're doing. They're an expert in that particular way. Just kind of give them data sets that either help with their conviction or help give them a contrarian opinion, and let them continue to make their own decisions on that. Fundamentally, though, we're seeing some of the better managers start with a data, kind of mindset and take human emotion out of it. But ultimately, you're not going to you're not going to be able to change the way some people are acting if they're not willing to change and do that on their own.
I would echo everything Rich just said. I think that personalities is the biggest part of it. You've got a group of quants and data scientists who are not, shall we say, generally speaking, people. You've got fundamental folks who may have just found out that Python isn't just a snake. And so that interaction can be challenging to manage at best. And really that, they really need to understand from each other where the tools and the knowledge and the things they need to do together come from. And I think that that's, really the biggest challenge is there's a lot of knowledge a fundamental manager has that a quant can stand to learn to build their models better. And I think the best quants are the ones who understand that and can try to incorporate that knowledge and make the computer emulate the better parts of what people do. And the best fundamental managers are those who can say, deliver me data and have it teach me things that I otherwise can't know. One of the questions that comes up a lot is people ask, what is alternative data? And I think the simplest answer to that is anything that people haven't used in their space is alternative. If you look at the quant side of things and you look at equity research reports that fundamental managers have been using since forever, that's very much alternative to them. If you look at, news sentiment and things like that quant managers have been using for a long time, that's alternative to a fundamental manager. And the question is, how do you translate those things to each of those populations so that they can actually make use of it rather than just giving them a set of numbers they don't really understand and all they can do is hurt themselves on the sharp edges?
On my side, personality for sure. But I work for a large institution, so I have to convince a lot of people. Historically, what I find, if I had an idea, quite often I will work closely with a client and try to develop the idea with a partner on the buy side. There's going to be a cooperation, typically with a buy side, on some occasion a vendor, and we'll do a proof of concept. And it can be market data, it can be an execution concept, it can any type of new product development. Like years ago, I remember when I first did sponsor access, everybody thought I was mad. This one we did it with a large firm, which was well known, and that allowed me to go around those political barrier or strong personality internally. Because as a large institution, we like to sell well understood, scalable solutions. So when I come with a new idea in front of the senior management, it's borderline impossible. So I need to find a buy-side client which has a very good reputation, where the firm wants to grow the relationship, and then I can use it more as a beta test. And then hopefully if it's successful, we can use it as an example in order to implement that whatever solution across the firm. But it's very hard for me to build it hoping they come.
Okay, maybe one more before we launch into Q&A. And I was just curious, and it can be a one-word answer, but I suspect it won't be. So, given if you're a firm and you're really looking to kind of ramp up in a big, you call it a big data strategy, and you're trying to figure out, where in my firm is this strategy going to make the most impact, right? Is it going to be more in, like let's say I engage in both a systematic and more fundamental approach. Is the bigger opportunity within systematic quant, or is the bigger opportunity within fundamental? Is it a marriage of the two? Is it kind of a mix of the two?
That's a complex question. Can you rephrase it?
Sure. So if I'm ramping up a new big data science strategy within my firm, and I've got both a quant side of quant overlay and a more fundamental oriented approach, where's the impact going to reside? I mean, am I going to be putting together, within the quant overlay, say visualizations that help my fundamental oriented analysts make better picks? Is the benefit going to come from better with the overlay of better alpha gen and better risk?
I think you need both.
And or the answer can be a mixture of both. It's a marriage of both.
You need to visualize it,
Yep.
And you need to also have the quality of the information. One of my biggest issues, which we have not mentioned, is cost.
Yep.
I mean, if I look at the last 15 years, my biggest increase in cost overall has been market data as a firm. I mean, I come from the futures world. Futures data used to be free. The exchanges didn't charge for data for a very long time. Now I get a charge per user. So if I develop a new idea and I start publishing that data to all my clients, I got to think twice before I do that, because I'm going to pay thousands of dollars every single month in exchange fees, so on and so forth. I'm just using exchanges as an example. So yeah, I would say putting aside the visualization and how to implement it, one thing which is critical for me is also the cost. I have to be very, very careful because I don't have an unlimited budget.
I don't think there's too much question that, I mean, with any information you can take into an investment context, the best way to leverage it is to get it to as many people as humanly possible. I think the question becomes, what's the right path forward? And I think, every firm is different in that regard. I think the easiest way to think about it is, if you take a look at where you are and what's going to ultimately drive your business the most, the more you can target it to those couple of basic things and start there. And if that's naturally more of a quant focus, great. If that's naturally more of a fundamental focus, that also fine. But you just need to be realistic about the work it takes to create that it's not just like, hey, we'll get one person, we'll buy some data and magic will happen. Data has to get loaded, data has to get analyzed, data has to get sourced. Maybe there's one person that can do all those things, but there's only 24 hours in the day, and so unless you also have a time machine, there may be other elements that need to come into play, and there's firms that have come along to outsource and work with some of those tasks, not all of them. There are things you may trust people to outsource, but not all of them. And ultimately making that decision, I think, is a really highly individual task for everybody to really consider, what exactly is going to move the needle for your particular shop.
Yeah, I think there's definitely value in both sides, but I'm a firm believer in the biggest impact I think is going to be in the quant space. Evan mentioned it earlier. You put something in your model, you find out what your return on that cost is, you put it into production, you make money. It's not so clear and straightforward on the fundamental side. And if you're going to go and develop a data science team and buy the data, you're talking about multi-millions of dollars worth of investment on the hopes that somebody might make a better play in the future and those kinds of things. So from a risk-reward perspective, a clearer path exists on the quant systematic side.
Great. How about we open it up to Q&A from the audience?
Congratulations, you now won the buzzword bingo with AI. Yeah, so I think we have a number of different managers on the quant side, and some of them use AI and machine learning. I think one of the biggest opportunities that I would see with machine learning in particular is the ability to sort of test a data set very quickly, find out where there's value. On some of the highly dimensional data sets out there where you've got a bunch of rows for each ticker and 40, 50, 60 columns worth of attributes, you don't know what any of those mean. So machine learning is a great way to sort of get that process down to something that's much more manageable. Whether or not true artificial intelligence is there, or whether or not the AI is augmented intelligence for humans, I think I don't think the industry is there yet on true artificial intelligence.
I'm reliably informed that some of our fundamental guys use Siri on occasion, so if that counts, then yes, we're using AI. But beyond that, I think the biggest question with machine learning is really being careful how you deploy it. There's things that machine learning can do really well, especially if you're doing a lot of things at scale. I think machine learning can also be horribly misused and can overfit things in a way that are quite dramatic. And there's an old joke about machine learning where people say, "Oh, we don't understand what the inputs are," and you say, or they're not knowable, and you say, "No, they are knowable. You just don't know what they are." And so it has to be deployed very judiciously. And I think that because it is such a buzzword and it is something that so many people like talking about and touting, you really have to make sure it's the right choice for what you're doing and not just the sexy choice for what you're doing.
Yeah, based on what I see from the feedback I get from my client, they use AI to analyze huge set of data, scrub the data, and identify some opportunity. But from a pure alpha trading point of view, I cannot think of a single client where I would say they use AI to fully implement the trading system. No, they use it as a tool, but you don't have this magic bullet yet where the computer trades 100% of the time. No, I've not seen it.
Any other questions from our audience? If not, I'll say thank you for your attendance. Thank you to our speakers today. And thank you to NIBA. And without further ado, welcome everyone to the cocktail hour.